Hello and welcome to our webinar today on positioning your 401k and portfolio for the 2020 and the new COVID-19 economy. Thanks for everybody for taking time to be with us on the call, hosted by Sullivan Wealth Management and Archer Investment Corporation. On the webinar today, you'll have the opportunity to ask some questions and speak directly to the portfolio managers and the investment advisors that select the investments for your 401k programs. I'll introduce them in just a minute as I see people are still logging into the webinar. But real quick, here are some of the topics we'll be covering today. We'll be talking about the advantages of having a 401k program in your company, the tax savings, employer contributions, and more. We're going to give you a current stock market review, talk a little bit about the economic outlook as we see it, how to position your portfolio going forward, and where we go from here. And so on the call today, you'll be hearing from Troy Patton, Managing Director and Founder, plus President of Archer Investment Corporation. And from Sullivan Wealth Management, we have Ryan Beckett, CPA, Raj Goenka, CPA and Partner at Sullivan & Company, and Paul Sullivan himself, CPA and Founder of Sullivan Company, who I think will be celebrating their 40-year anniversary coming up here in August, if I'm not mistaken. So with that, congratulations, and let's go ahead and get started with the call, and I'll introduce our first presenter, Ryan Beckett of Sullivan Wealth Management. Ryan?
Yeah, thanks, Jeff. So I just wanted to start with explaining kind of what a 401k is, just for anyone who's not familiar, and feel free to ask questions during the presentation. We're happy to answer at any point. So a 401k is essentially a retirement account that's offered by your employer that employees can contribute to. It's essentially a savings plan and an investment account for your retirement. And contributions to the 401k plan are done automatically and through payroll each pay period. So some people ask, why do I need a 401k plan, or why do I need to contribute? Well, the days of receiving a pension from a company that you've been working for 30 plus years are essentially over. And Social Security is really not enough for most people to live on when they retire, and people are really living longer than ever nowadays. And the shift to 401k plans from the previous model of receiving a pension has really placed the burden on saving and investing for retirement on the employees. So it's really important for employees now to understand what a 401k plan is and kind of the advantages of it. So turning to that, we'll jump into what are the advantages of making contributions to a 401k plan. And one of the biggest advantages is you get tax savings now on contributions you make to a 401k plan. Every dollar you put into the 401k plan is not taxed at both the federal or the state level. So just taking an example, let's say you make a salary of $50,000 a year and you put $10,000 into the 401k plan. You're only taxed on $40,000 now. And just so people are aware, the maximum 401k contribution for 2020 is $19,500. And if you're over 50, if you're 50 or over, you can put in an extra $6,500. And I think it's important to note that you can contribute. That's the maximum you can contribute, but you can always do less. So if you just want to get started and can only do $100 a paycheck, that's fine, or you can also do a certain percent of your paycheck. If, just to get the ball rolling, you can do 5% or any other percent. That's the maximum, but you're free to contribute less. I'll just pause here in case anyone wants to jump in for questions or has anything on any of that.
And just so everybody knows, for those who are on the call, there actually is a little bubble, and you can actually click on that and type in questions as we go. I apologize for interrupting there.
Sure. So if you don't contribute for a particular year, can you catch up later in life?
Yeah, no, you definitely can contribute, later in life. Obviously, we definitely recommend people to start as soon as they can, even if it's just a little amount. Getting the ball rolling is really the most important thing we see here. Just as little as you think you can do, you just get it started, and you can always increase or change later. But starting when you can is the most important. But yes, you can always, start later in life.
I mean, the issue is really not if you should contribute, it's how much. Obviously, somebody can contribute $1 a pay period. So anything above that is up to the individual, but there's no minimum amount, and so it's really just a question of how much.
Can you stop contributing once you started contributing?
Yes, you can definitely do that as well. You can change it. Most companies allow it. Each pay period you can change. Obviously we recommend you kind of get started and consistently do it each pay period, but you usually can always change it later on. So if you start with 10% of your salary and then you say it's too much, you can drop it down to 5% later. Yeah.
You just merely put a form to your payroll department and they change it for the next payroll.
Right, like things change, and if you have a difficult time period, you could temporarily pause your 401k contributions, and then whenever you're ready to start again, you just let your HR people know, and then they begin your contributions once again.
Is there a certain age that you have to stop contributing?
As long as you're still working and receiving a salary from a company, you can still keep contributing to your 401k plan. There are certain distribution rules. When you hit a certain age, you have to start withdrawing. But as long as you're still receiving a salary, there's no age limit that you have to stop making contributions.
All right.
Okay. So jumping back in, another big advantage of contributing to a 401k plan is that a lot of employers offer a matching contribution. And a matching contribution is when an employer matches a certain amount of what you put into the 401k. So just as an example, let's say the employer matches 4%. If you contribute 4% to the plan, you'll also get a 4% match from the employer. So as an example, let's say you had a $1,000 paycheck, you put in $40 into the 401k, and the employer also puts in $40. The key here is if you don't contribute anything, then you don't get this employer match. So it's kind of an incentive for the employee to contribute.
Brian?
Yeah.
Is that match generally 4%, or does it vary by company, or is there kind of, a general policy for that match?
Yeah, it varies by company. A lot of the companies, if people are on companies that we work with, a lot of the match that we have is 4%. But it varies by company. Some don't offer a match and some do. So that's why it's extra important when your company does offer the match. It's really showing that the company cares about you and your retirement. So it's great to take advantage of the match when the company offers it. But yeah, it is on a company basis, and they do not have to offer a match. So
okay.
Yeah.
Thank you.
Any other questions, Sam?
And if I'm going to be receiving Social Security or any other type of investments when I retire, do I still need to put in money into the 401k?
Definitely, yes. Like we've seen with a lot of our tax clients here, Social Security it's just not enough for people to live on. It's really meant to be the absolute bare minimum, and we strongly advise people to contribute to a 401k.
Okay.
Okay, so another advantage of contributing to a 401k plan is that the contributions that you make to the 401k plan grow tax-free over the years. The gains, interest, dividends that are accruing in the account aren't taxed until you distribute them. So it really allows for a lot of tax-free years of growth. And just one rule to kind of be aware of is you can't take money out of the 401k account until you're 59 and a half without paying a tax, without paying a 10% penalty. There's some exceptions that we're not going to cover in this webinar, but it's important to note that that money is kind of locked away for your retirement. Any questions or anything on any of that or anything else? So, I think the biggest thing that we'd like people to take away is just getting started is the most important thing. It doesn't matter if you can't do the max or, you can't do as much as you want. Just getting the ball rolling of getting something started and then modifying it as you move forward is kind of the most important thing. Once years go by, you can't go back in time and recontribute in those years. You can only do, what you can in this year. So it's just so important to get started.
Ryan, I have a question.
Yeah.
Why are commission dollars not qualified for 401k investment?
Well, if you get paid as a 1099, is my assumption here, you could still do a 401k plan, but it would be a different 401k than an employer-provided 401k. It's called a solo 401k where you are the owner.
I think he's referring to where you have commissions and it comes through your W-2. Is that correct?
Well, I am a W-2.
Right.
I'm a W-2 employee, but my commission payments, I can't invest any of my commission payments into my 401k.
Right, but are the commissions reported at the end of the year in your W-2?
Yes.
Right. So the commission, anything that is in your W-2 qualifies for 401k contributions.
They do?
Yes. It's considered as salary. Commissions, whatever, bonus, whatever you want to call it. If it comes to your W-2, it's called salary, and salary, if that includes commissions, is eligible for 401k contributions.
Okay.
So if you need a separate answer to that, you can call us here.
Yeah,
we'll cover your individual situation.
Yeah, we're going to need to take this offline because we've been told specifically commission dollars are not eligible for 401k contribution.
Call us directly and we'll clarify all of it.
Okay.
Okay.
Any other questions or anything?
Is that because of the match by the employer?
I'm sorry, say it again?
Is that, when he's referring to the commissions, is that the employer match doesn't include commissions?
Commission, anything that comes to the W-2 is eligible for 401k. That doesn't matter what you call it. It's in the W-2, it's eligible for 401k.
If the employer matches 4%, does it still include that?
Yes, yeah, it's the same as regular. Whatever's in the W-2, whatever you want to call it, is eligible for the match, is eligible for 401k contribution.
Okay.
Jeff, did we see a question come up on the screen?
Yeah. Says the question is, when do I have to start taking the required minimum distributions, and how much do I have to take?
Yeah, RMDs are required minimum distributions. They start now at age 72, and the amount you have to take, it's kind of based on a formula, but we can give you a rough number or, your particular RMD number if you'd like it, but they begin at 72.
Unless you are still working.
Correct, yeah.
But if you're still working, you could delay your distribution up until the year when you stop working. There are some exceptions to that. So, for example, you're 75, you're still working, you don't have to take the R&D or the distribution unless you're an owner.
So that answers the question. The distributions for required minimum distributions in the beginning years are relatively smaller amounts when you first start. They're not, they start out on the smaller side and then they grow as you age. Are there any more questions?
Any more questions or anything before we turn to Troy for market update?
I got one question about when you invest your 401k investments, are they actively managed or do you put them in index funds? How do you invest your dollars?
Most
Investment selection for companies we do work for can be in index funds. It can be in our model portfolios. It can be in selected mutual funds. I mean, every investment that's available to anybody in the United States is available in our investment selection. There's nothing that Morgan Stanley or any company has that we don't have. So we have everything. The selection of the investments is individualized, and part of our job is to give education individually to the participants so that they can, share in a decision on whether it should go in which fund or which portfolio or index funds, and all that is part of what we offer as part of administering the 401k for the companies.
Okay.
I have a question. If I need a person to go over the basics of my plan, my investment options, and any other aspects, who do I need to speak with?
At our office, you speak to Ryan, Paul, Jane, Raj, and it's available on an unlimited basis by phone or in person. We offer an individual financial plan in given situations, but it is a exercise that's part of essentially what you pay for when you pay the management fee that's in your account. So you would call one of us. We communicate with you regarding what's available through Archer Investment Corporation.
Okay.
All right, so we'll go ahead and turn it over to Troy if there's no more questions.
All right. Okay. Let me move this here if I can. So thanks, guys. Actually, those are a lot of really good questions, so hopefully everybody can get those answers. The one thing that I would tell you on the RMD, I mean, just to kind of move even a little bit further, and obviously you want to sit down with Paul, Raj, or Ryan in regards to your RMD, but if you're 72, you can kind of look at it as it's actually just a bit under 4% of your balance as of the previous year end is what you're going to be taking, and then it goes up obviously as you get older. So, okay, let's go ahead and talk a little bit about the markets and the economy. I mean, the markets have been really interesting actually for the last several months. We've seen a complete slide in the stock market and a near rebound. We're still not all the way back up yet, but still a very significant rebound. And I want to just kind of talk about that and really what we're expecting. And I think this is a very interesting year because there's going to be a lot of things, a lot of factors that play into this stock market, whether it be a recovery or a possible retrenchment of some sorts leading up into November. So one of the things here, this initial chart I wanted to put on the screen here, and hopefully y'all can see it and it's not too fuzzy, but it talks about the initial jobless claims. Regardless of what happens, who is the president, who controls the Senate, the House, etc., the bottom line is jobs. And as long as people are employed and unemployment is low, people will spend money, the economy will move forward, et cetera, et cetera. Now, with that being said, we had a mass layoff, structure going on, in March. And since then, it has calmed down, but to the extent it's calmed down, it's still about 1.5 million in weekly jobless claims. And that's a problem because U.S. continuing claims are still very, very high. And we need that number to come down substantially for this recovery in the economy and the market to be considered long term. Right now, frankly, I think that the stock market is really just operating on fumes and fuel put out by the government. And why do I say that? If you actually take a look at this comes from a company called First Trust, and they have some ETFs in some of the portfolios that we manage. And you can kind of take a look at this. And the one thing that I'm going to point you to is, let's see, 1, 2, 3, 4, 5, 6 down is rail car traffic, the number of cars. And you can see the percentage of change year over year, and it's negative 14.9%. Okay, negative 14.9%. That's a really good indication for me that production levels in the United States are not near what they were prior to COVID-19. I mean, and I am going to bring politics into this because everybody wants to talk about politics. And if you don't think so, go to Facebook and you'll see every opinion you could possibly imagine. The reality is that whether I'm conservative or I'm liberal or whatever, there is actually a virus. It has caused issues, and people are reacting to it. Whether they're reacting to it correctly or incorrectly, only time will tell whether that played out correctly or it didn't play out correctly. At this point in time, production is down. It's down 15%. Okay, that's a problem. All right. And I mean, there's a lot of other things here: hotel average daily rate, hotel occupancy, hotel revenue per available room, open table, supply of motor gasoline, TSA checkpoint. I mean, take your pick. I do see box office receipts on here. I would tell you that's probably not a good indicator anymore because I'm not so sure that any of those are going to make it beyond this the issue that we've had with the COVID-19. One encouraging sign, though, is if you take a look at the May job openings, you can look back and say, look, job openings were quite abundant. And, then they fell off, obviously, because in March and April, I mean, nobody was hiring. I mean, March was still 6 million, but, the way I look at it is, well, that's because people ran ads on Career Builder because they were looking for people and they didn't expect everything to be shut down. So those ads were already in place. Now that we see the uptick back in May to 5.3 million, I do see that as a positive sign. I am going to be somewhat of I'm going to give you some negative feedback on all of this. The one issue that we have, and I'm speaking from my own experience, I have a relative that was working, was laid off, is collecting unemployment, $600 a week, and will not go back to work even though they've been offered jobs at Lowe's and places like that because they're making more by not working. So she's not the only one. I mean, this is a nationwide problem that we face. And again, I don't care what political spectrum you're at. Sorry, if you would make sure you mute your phones. I apologize if you're sitting listening. Okay, so this is an issue that we all face, and it's real. And if people don't get back to work, our government cannot afford to all government transfer payments, which means all money that flowed through retail sector, every part of our economy in the last 2 months has been 30% and 26% respectively. Prior to 08-09, those numbers were around 14% or even lower. In fact, they were almost down to 7 and even 9%. They got as high as 17% in 08. So right now, our economy is actually being fueled purely by Washington, D.C. and the printing presses of the Fed. There is no doubt about that. That's not up for debate. Those are just facts. Okay? And so, one of the things as we start looking at this market, we say, well, wow, what am I going to do with this? with my money? I mean, where should I be investing? And I want to, and all of what I'm talking about really dovetails into the companies. And one area that's been extremely weak in the stock market is companies that are paying dividends. And the rationale behind that is that companies aren't going to be able to continue to pay dividends as they have historically, because people do expect another downturn in the market. They always say the smart money follows dividends and bonds. Well, bond interest rates are extremely low, and the bond market continues to rally in face of all the government fueling of money, et cetera, et cetera. Dividends have done the same thing. As you can see, here we are in the pandemic, and the percentage of dividends above the 10-year yield is very high. Now, with that being said, the 10-year yield is only, I believe yesterday was 0.58. I apologize, I don't have that number for you today, but it's very low. That means, you're going to give the government your money, and they're going to pay you about 0.5% interest each year for the next 10 years. That's not very good. Okay. The other thing that I always get asked, and so I'm going to bring it up, is everybody says, wow, shouldn't we be buying gold? Shouldn't we be buying gold? Well, I've never been a gold bug. I mean, it's always risen and fallen, with pandemics and crisis and, and 9/11. I mean, take your pick, right? And once again, we see gold moving to a near high. I can tell you this, the world is going to a cashless economy. We're going to cashless payments. Everything's based on fintech. I don't think that gold is a good safe haven. If you want to think about it from an industrial standpoint, that's fine. But at the end of the day, this is going to sound so archaic when I say this, but if things ever get so bad that you think you can pay people in gold, I can assure you that you will probably be shot for that gold and never receive the goods you wanted to buy. So take that for what it's worth. We will not turn into a gold economy, because if we do, the rest of the world will actually go to a gold economy as well, and that would be mass chaos. So I'm not saying whether it was right or wrong to devalue the dollar to gold, but at the same time, I'm giving you my perspective on that. Okay. So one of the things that when we think of in the stock market, and all of you have seen this. I mean, if you're invested in our 401ks or any of some of our funds, you're probably invested in Amazon, Facebook, Microsoft, Google. You're probably invested in each of those stocks. I can almost assure you that. And if you think about that, people are saying, wow, I mean, why are dividend stocks doing so poorly? Well, I mean, we have a lot of people investing, and I always say, think of Amazon versus Exxon. What would you rather invest in? Well, Amazon, has done really well during all this because everybody's ordering things online and shopping from home. Exxon is not only is it carbon, fossil fuels, which are somewhat negative, but we have a lot of electric cars and people aren't driving as much, and I mean, frankly, they're just out of favor. They're really just not very sexy. And I will tell you this. I mean, in the meetings that we have here internally, we often think of Exxon or any other fossil fuel company as having a life probably less than, 10 to 20 years. I mean, we really believe that the economy will continue to move away from fossil fuels and into more renewable sources. Okay? So what do I invest in? Where will the market go? Well, this is the question everybody wants to know, and they want to know if the market's going higher. If not, how low will it go, or how high can it go? And where do I invest? So this is the question that always gets asked of us all the time, and I'm going to just kind of bring this up by simply stating this. This market could actually move 20% higher from here. And this market could actually move 20% lower from here. If you get the quarterly newsletters that Paul sends out, I can assure you that our economy is going to be tied to the success or failure of belief of people getting their arms around it, whether one be a vaccine or a permanent treatment that is acceptable to everyone for the COVID-19 pandemic that we're facing. And I'm saying this because this is, whether people want to believe it or not, this is not the first time the country's faced this, but it is the first time the country's faced this with, and again, I don't care if you're right or left, media outlets that are completely off base, regardless of which side you think is accurate. I'm telling you, it's all, a lot of it, I would say 90% of the media is off base, period. Okay? I mean, they don't report news anymore. This is not Walter Cronkite, reporting the news. This is actually people voicing their opinion and calling it news. So the bottom line is this. We have to have a vaccine. We have to have a vaccine that people believe is appropriate and that can bring down the levels of COVID-19. Until we do that, we will continue to have mass panic. We will have governors ordering masks. I'm not saying that's right or wrong either. Frankly, I wear mine, but at the same time, I do see it, as there are other issues with it. So, this is the problem that we face as a country. This country is very divisive, and it's very polarized. And I would tell you, in the past, I didn't care whether Trump or Hillary was elected. I really thought the market was going to move higher. I think in this market, I don't think it. I would like to say it probably doesn't matter, but people are very divisive. And I think there could be some more panic and turmoil, not only with the COVID-19, but political unrest heading into November. And I don't think that bodes well for the market short term. Now, with that being said, I'm an investor. I'm an investor just like you, and I invest in the exact same things that you invest in. I'm in my 50s. I believe in long-term investing. I believe if you're in your 60s, you should be a long-term investor because you're likely going to live past the age of 85. Those are the numbers today. So with that being said, long-term investing requires you to invest in stocks. It doesn't mean the market can't drop 20% and it can't move higher by 20% as well. But at the same time, if I look down the road from 10 years from today, and let's say people always ask me, say, well, Troy, what about inflation? I mean, the Fed's printing a ton of money. You're right. There could be a lot of inflation. But typically, if interest rates stay low, as the government has deemed to do, interest rates are not free market anymore. They are not. This is not a conspiracy theory. It's just a fact. The Fed continues to increase their balance sheet by buying additional bonds. If interest rates stay low and inflation rises, think of it in terms of Coca-Cola. Coca-Cola, maybe they sold 100 cases of Coke last year. And this year they're going to sell another 100 cases of Coke. Last year they charged $1 for each case of Coke. And this year they're going to charge $1.10. It didn't mean that they sold more Coke. They just raised the prices. Those people that are invested in Coke, that bottom line, the net profits will also increase as well. And therefore their stock will also increase. Again, that is if interest rates stay low from a government perspective. So if you put that into perspective, 10 years from today, I would expect the market to be higher. Lastly on this slide, and I know I'm talking quite a bit here, but it's whatever risk that you can stomach. If you can watch the Washington Nationals, right, win the World Series and you expect them to win the World Series, you are going to buy tickets and go see those games. If they're going to be less than 500, you're probably not going to buy tickets to buy the games. Obviously, right now, nobody's buying tickets, just cardboard cutouts. But with that being said, you would generally not buy tickets. The stock market's the same way. If this market drops 20% tomorrow, we will have clients saying, oh my gosh, we need to get out. And amazingly enough, when it goes back up 10 to 15%, they'll say, okay, now I want to get back in. And I can tell you, we get those calls all the time. We try to talk people out of it. We say, hey, if you're a long-term investor, stay long-term. If you don't believe that you can stomach that, buy 50% equities, stocks, and 50% bonds. And Paul and Raj can help you through that process of picking whatever your risk tolerance is so that you can sleep at night knowing that, you're your nest egg will be there when you retire or when you need it most. Okay? All right, last thing I'm going to talk about is earnings. Earnings, as you can see, and by my red circles here, they've become very anemic. We need that number to be above 1 for our economy to expand, and right now we are not expanding. So even in the face of the government putting tons of money into the market, our economy and GDP is not expanding, and that will catch up with us. And if we do not expand and create additional profits, the stock market will decrease. So that's why we need the vaccine, and we need some kind of permanent outcome for this. All right. Here's just another slide. I actually have given this before. We've become more of a software structured economy as opposed to structures. We have less manufacturing. We are more of an app economy. That is why you see technology doing so well. Okay. This just kind of goes along with the market, like what I was saying. We actually were in a secular bull market up until the probably 2000 through 2008, 9, 10, 11, and now we are back into that secular bull market. This economy will continue to expand as long as we have a permanent solution for the problems that face us today. And by the way, there will be another problem. It may come up in 5 years, 7 years, 8 years. I don't know when. We've faced world wars. I mean, pandemics. You name it. I mean, we've faced it, and we've always come out ahead. I mean, we are undefeated in comebacks in this country, and I don't think this time's going to be any different. Okay. That said, there you go. Does anybody have any questions?
Any next question? You don't ask them.
Thanks, Troy. If you have questions, and again, if you're online, in the upper right-hand corner of the Join Me dashboard, just unmute yourself, and then you should be able to talk. Correct, Troy?
That's correct. Or you can type in a question too, if you're on a keyboard that doesn't have a mic or something.
Paul and Raj, if we don't have any questions or we're waiting while some come through, or do you guys have any other comments on what Troy was talking about, or you want to add?
Well, I would say if you have any question that pertains to your personal situation, you're also welcome to give us a call separately if you don't want to discuss it during the webinar.
Right. I will say this. I mean, I've known Paul for quite a while, and I really do think you guys have a great firm, and your interests definitely lie in helping your clients succeed and meet those goals, towards retirement. And that's the bottom line. Investing is going to come and go. It's going to come in favor and out of favor. The bottom line is continuing to invest over time, and that's really where 401ks are very important, because investing over time, investing across all market cycles, will actually make you a winner at the end.
Well put, Troy. Paul and Raj and Ryan, if somebody's listening maybe on the replay as well as here live today, Paul, you mentioned there's 2 ways to get a hold of you. The main number, 240-800-4300. And if somebody wants to walk in, the street address, as everybody knows, is 4709 Montgomery Lane. Any other ways to get a hold of you or call during the week?
Right now, we're specializing in Zoom. We get a lot of it. We actually, accounting and also investment, all they have to do is hook in on Zoom, and we can talk to them face to face, which actually is a pretty good system.
Yeah,
but they also have an option to go on our website, and then they can submit a question or comment they have, and we contact them, either via Zoom or via phone call.
No, I don't think that gets
there. Good. And the website that Raj was mentioning is esullivanwm.net, esullivanwm for wealth management.net. Troy, did we have any other questions come through, typed in online?
That's all.
That's all? Okay,
Yep.
super.
All right. Thanks for having me, Jeff. I appreciate it. Paul, Raj, Ryan, I appreciate it.
Thank you.
Thanks.
Thank you. Bye.
Thanks, everybody, for being on the call today. And again, if you have any questions, get a hold of Raj, Paul, and Ryan at 240-800-4300. Again, they can either help you on the phone, set up a Zoom meeting, and you can get more information online at esullivanwm.net. Thanks again, everybody. We hope to talk to you soon. Take care. Bye-bye.